No, no, no. I'm gonna put it on the see if the live stream's on. Okay, here we go. So hi, I'm Shock Exchange. I'm here with Tony and Mitchell. Obviously, this is Trump and the GE. And tonight we will discuss how short sellers are running a Ponzi scheme. Short sellers pursuant to Endo International stock symbol is ENDP. And as most of you know, Endo is a generic pharmaceutical company. It also has some branded drugs like Xiaflex and Quo, and it has litigation, which is slowly resolving. Exposure to opiates has declined rapidly over the past couple of months. They were hit with a default judgment in Sullivan County, Tennessee, a few months ago, and they were threatened to be hit with a default judgment in New York State last. And they resolved all of those, both of those claims. They resolved the default judgment in dollars, much less than the 2.4 million some we're talking about, and they resolved all claims in the state of New York, and counties in Long Island for $50 million, which came as a pleasant surprise. And the stock still trades below $3 a share. And we're trying to figure out why. We know that the stock is very thinly traded, and we discussed the effective float a few times on here, where we call the effective float the amount of shares not owned by institutions and insiders, which is about 17, somewhere between 15% and 20% of the total float. So the stock is very thinly traded, but insiders and institutions don't really sell. So the amount of shares that short sellers could potentially buy back would be very limited, in our opinion. So we can't figure out why the stock didn't spike on Friday on 120 million shares traded, which is about, I guess, about 60 normal trading days for Endo, which would be, I'm guessing, about 3 months worth of trading volume on one day.
Right.
Maybe less, 2 to 3 months worth of trading volume on one day. And the stock still didn't go to $15 or $20 a share, still trades below $3. We're trying to figure out why. It's difficult, I think, for short sellers to cover because few shares to buy back because, but they figured out a way. So we're going to try to unravel that today. I think they're kind of running a Ponzi scheme. And a Ponzi firm pays older investors with new money coming into the firm. So they pay older investors with new money. And the scheme can continue to work as long as either older investors don't want to redeem or they keep new money coming in. So they have to pay off older investors. And that's what happened. Madoff was running a Ponzi scheme for years. Never really unraveled because, but people who did redeem, he was able to continue to garner new money to pay off people who wanted to redeem. And that worked up until the financial crisis when more people wanted their money back, and he couldn't garner new investors amid the financial crisis. And he just turned himself into regulators and said, I can't lie anymore. I can't do this anymore. In this example, what I think is happening, I think that there's a bunch of hedge funds who shorted Endo, and they're trading amongst themselves. So, and what I think is going on, it's hedge fund A makes its shares available to short. Hedge fund B borrows those shares and sell them immediately to drive the stock down. Hedge fund C then buys those shares at a very low level to cover its short interest. And they keep this scheme going on back and forth between each other. One's shorting and one's buying at low levels to cover its short interest. So the stock is either trading sideways or going up a little bit, then going down, but practically trading sideways on a tremendous amount of volume. And I think this happen as long as they continue to find more shares available to short. So have tens of million shares available to short in order to keep the scheme going and keep Endo depressed. So and it works in like a Ponzi scheme in that way that they have to have more shares available to short. Someone shorting, someone buying at low level and covering at short interest, and volleying the shares back and forth. A lot of volume in the stock price. And so we're going to talk later about things that investors can do to sort of offset this manipulation. But that's sort of my high level take on what these hedge fund managers are doing. And it may not be just out of greed. It may be out of a need to survive. I don't think anybody ran up says Endo is worth $2.83, where it closed today. So we're going to short it down to 283. I think they found stock they can manipulate. They've been manipulating for years. They made lots of money. And now they may be trapped because they've had to continue to amplify the short interest to keep the stock depressed. And someone may be trapped. So when I say there may be a need in that, there may be a couple hedge funds in that chain link. If the stock spikes and there's a margin call or a capital call, someone may not be able to meet that margin call. Someone may go belly up. So if someone in that chain link goes belly up and they all are counterparties and they all have exposure to each other, they may have to bail each other out, which happened with the GameStop, short squeeze where Citadel ended up bailing out Melvin Capital. And it may not have been out of altruistic motives. It may have been because they had exposure with each other. The other thing is that if someone actually goes belly up, it brings more heat from the media, from policymakers, and from lawmakers. So if a hedge fund manager goes belly up, then you have SEC involved. You have other regulators involved. You have the media writing about it. You have lawmakers like Elizabeth Warren, Maxine Waters, Bernie Sanders, AOC, may want to have a congressional hearing about it. And what's happening is that banks require these hedge funds to put up more capital to better reflect the risk. They may shut down the short selling in a major way. They may raise borrowing costs. Some of these companies are borrowing at 25 basis points to 50 basis points, and it doesn't reflect the risk involved. They may say you have to borrow at 500 basis points, or 10%, or 20%, or what have you. So a lot of things could happen that could cut into the profits in this trading scheme for everybody, not just a couple firms that went belly up. So that may be why they're trying to keep the stock depressed for as long as possible, to keep someone in that chain link from experiencing a margin call and potentially going belly up that could potentially affect a lot of hedge fund managers. So that's sort of my take on it. So I'll let Mr. Mitchell weigh in.
Yeah, it was, after the surprising verdict, the surprising judgment that came out, I think we both expected, and maybe even the rest of the folks that have been keeping pace with the opioid crisis, and as it relates to global settlement and a lot of the companies that are within trials throughout the country. I think we expected a longer period. When we look at Judge Virgilio, hopefully I'm not chopping his name up too badly, out of Suffolk County, I think we expected, maybe another few weeks, could have been another few months, the way that the state AG, Letitia James, was posturing and pushing for a specific outcome. And it seemed like both parties were pretty firm in where they stood on their respective sides. So I certainly, for one, was kind of pleasantly surprised, because as I've stated time and time again, that what is the point of the delay? The only thing that it seems that we're delaying is getting the money into the counties, into the states, that can then turn that into treatment and prevention. And I'm gonna pat myself a little bit on the back, simply because after looking at the $50 million, as I stated, I think a few times prior, that it wasn't going to be that much higher. than the state of Tennessee. The state of Tennessee got 35 million. What does a dragging out look like in terms of risk versus reward? And state AG's office out of that $50 million judgment ended up getting, as you know, 13 million. So, when we quantify that risk versus reward, you made folks wait even longer. You made states wait even longer. You made counties wait even longer, simply for an additional 15 million. Was it worth it? I would argue that it probably wasn't in the sense of the time that it took. If this was the amount that uh, the state wanted and the state AGs were pushing for originally, then it certainly would have helped to simply articulate that in the beginning, even as a starting point for negotiations. But uh, with all of that being said, I was excited that this thing was kind of wrapped up. This is one more verdict down for Endo, and a pretty significant one on top of that. So, we saw the stock spike a little bit in pre-market with the expectation that it would move significantly more. I, I want to say pre-market had already done a 60-day average before the open. I think it was somewhere around 4 or 5 million shares had already been traded, which for Endo, at least folks that are familiar with Endo, know that this is not a heavily traded stock. This is not something that moves significantly fast in either direction. It moves pretty slow, the downside as well as the upside. And you may end up the day, you're lucky if you get to 3 million shares traded for the entire day. So to see the volume pick up, obviously the expectation that the market is seeing what the effect of this opioid finalization for the state of New York is going to do for Endo stock price. Disappointingly, it topped out. I think it opened at in the 270s, I believe, 274, something like that, and topped out at 333, and then just trickled the rest of the day down. You're counting candles. For those that kind of count candles, you can see that the sellers had the day. If I had to guess, at a pretty close percentage, but maybe 55%, and the buyers had 45% of the day. So presumably the shorts took the day, and it was a real head scratcher. So for me, when I see a response like that, and there's a certain expectation that the market is going to see the fair value of Endo, you have to do a little bit of investigative work, right? You got to turn into a little bit of a detective, and that's ultimately what I certainly did, because it was a real head scratcher as to why the stock did not have a more aggressive response in the market. And I think the first and kind of easiest answer, right? Like, this is already a company that's trading at penny stock levels, although I staunchly argue that this is not a penny stock company by a long shot, but it is trading at penny stock levels. So the easiest answer is that, well, maybe it's a shitty company, right? Like, maybe the market is showing the real value. Excuse me, I'm gonna drink a little water here myself. Maybe the market is just simply showing the real value of Endo, right? Like, maybe this really is just a $3 company at best. And it's like, okay, sure, well, that would be the starting point, right? Well, how would one prove that this is either a crappy company or it's not a crappy company, right? And as we've stated before, if one made that argument even 4 years ago, it would be a hard point to argue against when you had mesh claims, you had vasostrict, and then on top of that, the introduction of the opioid crisis and what the fallout was going to be. We're already looking at Purdue, Pharma, Insys, J&J, some of the larger biopharma companies. And it was just a slew, like an onslaught of litigation after litigation after litigation. that only so many companies, even the best companies, are going to be able to sustain under that weight. So someone made that argument to me 4 years ago. It would be a hard argument to argue against, and I would likely have to look at the logic, look at the numbers, see what the company is doing, and may be inclined to agree that although they were making some sound decisions in terms of revenue, in terms of products, they had about 30% reliance, or their revenue was 30% reliance on generics. They reduced that exposure on generics. And over the last 4 years, in spite of reducing their dependence on generics, in spite of the mesh claims, and ultimately ended up continuing to pay out the mesh claims, even with the vasostrict litigation and now the opioid litigation, that this company has, excuse me, gotten stronger. Their balance sheet over the 4 years, in spite of all that they were facing, all the litigation, all of the unknowns. Like, how do you price in litigation? And that's typically the thing that has investors the scariest, right? Like, when you see any type of litigation, certainly any talks of bankruptcy or restructuring, investors, rightfully so, get skittish, because how do you price that type of risk in? And pricing that type of risk in is a daunting, can be a daunting process, especially when there's no clear path to the end. And in spite of all of that, Endo has managed to not only simply survive all of the litigation and the debt that they continue to service, but they have managed to thrive. At this point, they have, a reminder, $1.5 billion dollars unrestricted cash. They have just developed arguably one of the most innovative drugs in the aesthetics sector, Quo, which is the first and at present the only injectable treatment for cellulite that has shown a 98% efficacy across all phases of cellulite. So from the most mildest cases of cellulite all the way to the most extreme cases of cellulite, has shown a 98% efficacy. Um, so they've managed to continue to R&D, continue to acquired, made two acquisitions just within the last 2 years alone as well. Um, so arguably, when we look at this company and we look at the moves that they have made over the past 4 years, and especially just even in the last 16 months, that this company has been hands down stronger company. And there is nothing that suggests that this company should be trading, certainly at anything below $3 a share. Even if we simply just look at the revenues that, excuse me, that Vasostrict was going to bring in, as well as now generic Chantix and Xyloflex, and we look at now Quo. This is going to be a year over year massive growth, as it has continued to be over the last 2 years, really. Quo pushed back a little bit because of COVID. It just seemed like, with this company, it was just one thing after the other, one thing after the other. So I almost don't even fault critics of Endo for some of the criticism that they've given, because it does just seem like it's a mixture of bad timing, bad decisions, just one thing after another, and it gets a little daunting as a long-term investor, or potential long-term investor looking at Endo and just kind of stepping away. With all of that being said, these are the things that one has to look at to ultimately determine, well, is this a crappy company or not? Is the market simply showing us this is fair value for this company? And arguably, one of the things that I kind of looked at is, and I think you alluded to it earlier, is looking at the enterprise value of this company. So even enterprise value alone, of a potential buyout of the company. So essentially taking the unrestricted cash on hand, looking at the existing debt, and kind of pricing in what does any future litigation potentially look like, because those are the things that tend to keep a company from being acquired, because there's this unknown amount of debt that may be coming down the pipeline. And obviously, the price that you paid for this thing is now exacerbated because now you have this unknown debt that has just been known and then dumped on your shoulders as the acquirer. And even including that, the current debt levels, you're looking at a 30 to 31 dollar price target uh, to build in that type of risk. So even at an enterprise level, this tells us that this is trading significantly below fair value, let alone when we look at the strength of the pipeline. So even if we simply isolate Quo and see, well, what is the potential of Quo year over year? What is a 5 year look like? What does 10 year look like? And obviously, they're going to be stepping into Botox arena. I would argue that they are going to Quo in and of itself, simply because it treats a condition. Cellulite is an aesthetic issue, but it also is a medical issue for about 10% of those that suffer with cellulite. That you do have these severe cellulite cases that become a chronic issue. So it's simply not because you want your wrinkles to go away. It's not because you want to look, 30 and you're really 45. So it's not simply for aesthetic reasons, in other words. So because of that alone, this puts Quo in the position of a trump card in terms of what their performance is going to look like, their access to the market, access to the type of patients that they can, even across classes of who can afford this particular drug or not. So even when we're isolating for Quo, this puts Endo easily between a 29 and $31 price target per share. All of that to say that ruling out kind of the easiest and kind of quickest answer, right? Well, maybe it's just a crappy company. That where's the evidence that this is a crappy company? You have to back it up with some evidence. And if there isn't any evidence, now we have to kind of look to, well, what's happening then? What's really going on? Endo filed their S3 about a little over a month ago. I want to say it was August 6th, sometime between August 6th and August 9th, filed the S3. So, as we've stated before, we think the best use for shareholder value as well as cash is to begin buying back shares. So, with all of that being said, one of the things that I looked at, much the same as you, Ralph, I looked at the shares sold short. Quite often, Yahoo, more of the public, like Google Focus, Yahoo, they update their information twice a month, but you're getting information that's a couple weeks old. Some of us that have access to more up to date information or kind of real time information, FINRA updates their information significantly more frequently. So one of the things that I noticed was that on that same day, a little over 43 and a half million shares were shorted that day. And that certainly explains the type of response of why Endo kept hitting kind of this ceiling even in the way that it was moving throughout the day. You definitely expected some significant pops here and there because of the buying action, because of block orders that may come in. But it seemed like it just kept getting chopped down, hitting resistance levels. And even the way that it was hitting resistance levels to me was odd. It was just really, really odd. And, when we look at the ticker tape, of course, now, being the Monday morning quarterback, we can then see, this is why. So shorts were having an absolute field day with Endo. But the curious and equally dangerous part about this thing is looking at the effective float, which, as we've pointed out, once we subtract institutional holdings, insider holdings, and we look at the float itself, how much is left of that float? And before Endo filed their S3, we had the effective float peg somewhere between about 36 and 39 million shares, roughly. So, which kind of explains how thinly traded the stock is on a day-to-day basis. So when we're in a position where the company has filed an S3, they are buying back shares. One of the question marks become, well, how many shares have they bought back so far, right? On some analysts, on a very conservative estimation, 10 million shares between August 6th and today. The highest estimations that I have seen is anywhere from 40 to as high as 50 million shares just by the company. Even on the conservative end, taking out 10 million shares out of the float and retiring those shares where institutions hold 83% of a float, so they're responsible for just shy of 170 million shares out of 194 million shares as an effective float. And then that only leaves uh, retail traders. So just looking at those numbers, that leaves us with only about set roughly, 16, maybe 15, 16, 17 million shares that are traded. And that's if we use the most conservative estimate of 10 million shares that was traded or that was bought back by Endo. If we are anywhere close to around the median, 30 million shares that have been bought back by Endo, now this gets us into a very, very precarious area. Because at this point, the question becomes, well, what shares are available to short then? If institutions are holding on to 83%, and out of that 83%, you have only five firms that are short only, while the other 320 firms, one of which is BlackRock, largest asset manager on the planet, has since January alone has doubled down on their position within Endo, picking up shares on the cheap, which I can't blame them. You have long-term investors like John Paulson, Polson Capital, who has doubled down in their position. You have Citigroup, who even before the S3 filing bumped up their projection from 6 to 7 all the way into the teens. So, in other words, the institutions that are participating are some pretty big players, and they are in Indo for a long-term hold because they clearly see the value. So the question then becomes, what is short seeing? What is the out here? Because if Indo is buying back anywhere from 30 million shares and institutions are holding on to 83% of the float, where's the give that allows shorts to then get out of their position and to get out of their position without, frankly, without blowing their accounts up, without becoming another Melvin Capital? And to your earlier point, this is where one really has to question then, a, where are shorts getting the shares available to short, and then B, what is the exit strategy of shorts here? Because this thing is pretty much at the bottom. There's only one direction to really go from here. And if it took you another 43.5 million shares to keep this thing depressed, it still closed 25 cents higher. It opened in the 260s, closed in the 280s on the day, so still closed up, although it was down 30 cents from its peak. The question is, how many more shares can be continue to be shorted at that level to allow shorts to continue depressing the stock, in other words? And that's where the real question becomes, well, is this thing a Ponzi scheme? Because now that you've ruled out some of the more topical areas of logic, now you have to begin to scratch beyond the surface, because all of that is just surface level, right? And now we have to begin looking beyond the surface. And this is where that question of what are shorts doing, because this is really only an eventuality, where you have this bottleneck and this pressure that is building up because shares are not going to continue to be made available to short. So that, yeah, that's just kind of my take and where it led down that rabbit hole of curiosity for for Endo.
Okay. Thank you for that. So I think it seems pretty clear that they have to continue to short this stock to keep it depressed. And some may say it's a short squeeze if it rises to $15 or $20 or $30, but is, in my opinion, is really just trading closer to its intrinsic value. So to keep the stock from trading closer to its intrinsic, keep a lid on it, which means they have to keep shorting it. And if they ever run out of shares available to short, it implies that the stock could spike. This isn't a $3 stock, and it's not trading below $3 because someone thinks its business prospects are dismal. It's trading below $3 because someone's manipulating it. And just give you a level of manipulation. On Friday, there were, again, like Tori mentioned, there were like over 43 million shares sold short on Friday. That's darn near criminal, in my opinion. To sell 40 million shares short on a $2 stock is darn near criminal. And I can't figure out why nobody else is looking at this, why it hasn't drawn the attention of other investors who see a desperation of shorts to keep this stock depressed. And over a 3-day period, Friday, Monday, and Tuesday, a total like 53 million short. And at the end of August, there were 23 million shares so short. So there could potentially be 70 million short interest at this point shares in that ballpark. And you talk about an effective float of maybe whether it's 20 million shares. I think you mentioned earlier that there
Right.
were we thought the effective float was around 40 million. They bought back millions of shares already, which we think they have. If the short shares not held by institutions and insiders around $20 million, that means that the short interest could be over 300% of the effective float. That would make Endo more highly shorted than GameStop and AMC put together. And this amount of short interest, definitely creates a risk, I think, for short sellers. It's just a matter of time before the market realizes that. And I'll also give you involved. They would the fee rate for the short interest, this borrowing was about 25 basis points for months. It just recently jumped up to 50 basis points. So even the banks realized that the risk has amplified. But in my opinion, that's still too little. That you have banks putting out dumb money. That the risk, they're basically betting that short sellers can continue to in perpetuity, and the stock will never rise to intrinsic value, which I don't think is realistic over the long term. It should be, the borrowing cost should be like 10, 20 times more than that. In my opinion, it's almost unquantifiable, the risk of shorting the stock at these levels. And I don't think banks are being paid accurately for the risk that's involved. Shares to allowing people to borrow these shares, and their borrowing costs should be much higher than what it is now. I don't know if that's 10%, 20%. I'm not sure, 30%, but it definitely should be a lot higher than what it is now. These banks are putting out dumb money. That's probably one of the reasons they want to keep any hedge fund from going belly up, because if something happens where a hedge fund or two hedge funds blow up, then every costs are going to go up. Everybody's cost of, I mean, the amount of capital adequacy they need to put up to engage in shorting stocks will rise dramatically, and then cut into a lot of these companies' business and their profits. So that's how, just that shows you just how highly shorted Endo is, much highly shorted than GameStop and AMC. And I'm not sure the market necessarily realizes this. And I don't think brokers necessarily realize how much risk they're taking on by letting people borrow at 50 basis points, in my opinion.
Right. I mean, I think another thing too is that, and we've stated it before, and I feel like it remains relevant, especially at these levels, is that it becomes a shareholder risk, it becomes a board risk, it becomes a company risk, because at these levels, when other savvy folks, like a Bill Ackman, like a Carl Icahn, are hunting for companies to be able to step in and shake the shareholder activist tree. This is a company that becomes ripe for the picking, simply because when you have this significant of a price differential between fair value and current trading levels, now the company becomes a target, and they are a walking target on their back. And really, make no mistake about it, the company has done phenomenally. I mean, management has done phenomenally over the last 3 to 4 years to be able to get the company from where it was 3 to 4 years ago to where it is today. The irony is that at the beginning of the year, we look at the stock price was trading in the mid tens. I think it peaked out at just under 11. And since the beginning of the year, the company has only gotten stronger. Yet the stock price has only declined. It almost seems like it has an inverse relationship. And this is, just from that alone, just a differential between an $11 share value and a $2 share value is enough for shareholder activists to be able to step problem with that. And, maybe some short-term shareholders or short-term thinkers may think, well, yeah, that would be it, right? That's the thing that will get us true fair market value, and to be able to get the market to recognize it quicker. But the issue with having a target on your back is that, yes, in the short term, it be shareholders may be rewarded for their shareholder activism. However, now you have the issue of getting rid of a rat by using a snake. And okay, it's like after you get the snake to eat the rat, well, what's left over? Still got to deal with the snake. And now you got to get a mongoose. But then what's left over? You got a mongoose in your house. So in other words, this problem just continues to get bigger and bigger and bigger, to now where the value of the company, of why you recognize this company, why this is a long-term holding, begins to erode. The company management isn't allowed the freedom to make decisions that led to the company's balance sheet strengthening, that led to the R&D creating the first cellulite injectable treatment that has ever been released. These type of things, these type of innovations, these type of nimbleness in the market gets removed, because now you have a snake and a mongoose in the house that you have to deal with, and that becomes the priority. Now the stock price becomes the priority, as opposed to innovation, as opposed to market efficiencies within the company, as opposed to growing as a company and focusing on what really moves a company, which is innovation and growing your customer base. So that's not really a long-term solution, and it's certainly not a long-term solution that I would like to see. Another issue is that even at these prices, that you also have other companies that are flush with cash, that are looking what are the best uses of cash. They're in positions that stock buybacks may not be the best use of cash because of the current stock prices. One of those companies that I would argue is in the same space is Moderna. Moderna has been trading astronomically over the past 12 months. Just in this quarter alone, they have, excuse me, over $7 billion of free flowing cash, and nearly don't know necessarily what best uses to place it. So, what better use than to diversify revenue sources and look at potentially targeting an Endo, buying up 20, 30, 40% of existing shares, but now you have a larger company that is potentially a competitor sitting on your board and getting access to board meetings and trade secrets and ultimately internal operations. If such scenarios were to happen, either a larger company like a Moderna or shareholder activists like a Bill Ackman or even a Kathy Wood, who just, interestingly enough, who just sold off another 200 million shares of Tesla and is constantly on the hunt for disruptive companies, which arguably the first injectable treatment for cellulite at a 98% efficacy would be considered disruptive. I would argue that that is one of the most disruptive products, not only to hit the aesthetic market, but to uh, hit the biopharma market really since the COVID vaccine. So the point is that there are sharks out there, and sharks are swimming, and they are going to pounce when they see this massive opportunity. So, in other words, what does that do? It's certainly going to put shorts in a trapped position if you have someone like a Kathy Wood who can come in and take that to even $200 million that just banked on selling Tesla shares at a 30% upside bounce and investing even 100 million in buying up shares of Endo. What does that do to the shorts then? But even more so, well, what does that do for the management? Do they want a Bill Ackman or Kathy Woods having that much ownership of the company? And and really, if the answer from the management's perspective is no, then I think the best action to take is to continue buying shares, continue retiring shares, buying up the float. Ultimately, this will lend to a rising asset price simply because at that point, shorts will be trapped. But then what does it do to shorts to have a Kathy Wood step in, a Bill Ackman step in, a Moderna step in? Equally, the same effect that it's going to leave their back against the wall. And ultimately, we're looking at a situation of another Melvin Capital here. And to your earlier point, when I did the math on the risk, there's about, in my estimate, about 65 to 67% chance of a short squeeze here. And building in that, basis points were around 25 basis points before the filing of the S3. After the filing of the S3 kind of floated between about 25 and 30 basis points over the last 3 days. That has jumped to about 50 basis points, as you stated. But based on the likelihood of a 67% chance of a short squeeze here, and that's without a Bill Ackman stepping in, that's without the Kathy Wood or Moderna stepping in. You're looking easily at the borrowing fee rate should be minimally 30 times what it is today. 30 times just off of the risk level alone. So for the institutions that may be allowing their shares to be shorted, to make a little money. I would argue that, clearly you are letting those shares be borrowed for pennies on the dollar. And if you're an institution, your fiduciary obligation is to your shareholders to get to maximize capital. And I would argue that clearly you're not maximizing capital because you're allowing these shares to be shorted pretty cheaply as well. The only folks that have, or maybe less of the awareness, are the retail holders. Where retail holders, you're holding it within your E-Trade account, your TD Trade account. You're just holding with it with a retail brokerage. I would argue that those folks can also talk to their brokerages. One of the things that even I often do is register my shares directly if it's a long-term holding, and register them directly with that company's transfer agent. So that makes the shares completely unavailable to short. So that means that that's not even an option, um, as opposed to the shares being at a retail brokerage and they're being held in street name. So for folks that may not understand that that's a process, or what that is that allows the retail brokerages or your broker dealer to be able to lend out the shares to be shorted, because essentially they're held in the brokerage's name, although you've purchased them. So, talk to the broker, talk to your broker dealer, and finding out how to register your shares directly, or what other options you have by not allowing your shares to either be shorted, or bumping up the price and making sure that, okay, if they're going to short shares, then I want to make sure that I see some of that price action that the institutions and the broker dealers are seeing. I want to see some extra money in my pocket as well. If everybody else is eating, I want to be able to eat too. And I think that's only fair, because I think that that's really the only kind of playing field that's left, right? Either institutions are allowing them to borrow, or retailers are their shares are being lent out, and I think largely without their knowledge. Because how many of us know, when you put your money into a bank, you go into the bank, you deposit your check. How many of us really know that as soon as you deposit that money into the bank, that money is immediately lent out
Yeah.
to other folks? Welcome to fractional banking, right? Like, that's how fractional lending works, is that the bank continues to lend out that money. And what do you get at the end of the year? At best, 2%, maybe, if you're with like a high yield savings account that some institutions have. But if you don't even have a high yield savings account, because maybe you don't meet the minimum threshold, you're getting what, 0.025%. And even high yield savings account in the last 12 months have dropped significantly down from 2% down to about 1.25 at best. I think on average it's about 0.075% that folks are getting. So equally, just like the banks lend out your money unbeknownst to you, and only give you a fraction of the the profit, if any profit at all, that you're going to be taxed on. The broker dealers equally do the same and lend out your shares. So, I would make the argument that you could at least talk to the broker dealers, and talk about getting a piece of that action, right? If they're going to borrow, if they're going to lend out the shares, make sure that they are borrowed at a fair value. And like I said, in my opinion, institutions, brokers should be charging easily 30 times what the borrow fee rate is currently at, which is about 50 basis points. So, because this risk is pretty significant, that there's going to be a squeeze on hand.
Okay. Yeah. So I think it's a good point. And if the stock again, the stock spikes, I don't think it's necessarily a short squeeze. I think it's I look at it more. Endo is. begin to trade closer to its intrinsic value, and the stock would, I mean, guess short sellers lower their level of manipulation because the stock has been manipulated. As far as where it's currently trading now, 6 times EBITDA is darn near criminal, given that the EBITDA, because we're still coming out of a pandemic. I think you'll see Endo's revenue, earnings grow. EBITDA margin is around 42%, which is fabulous for a company of this size, especially given the headwind from the pandemic. The more scale it adds, the higher its EBITDA will grow, and the higher its EBITDA margin will increase. So I think it's again it's Endo's fiduciary responsibility to buy back stock at these levels. The best use of his cash is 1.5 billion of unrestricted cash on the balance sheet. This is the best use of his cash. I think it was also a fiduciary responsibility for certain larger competitors who may want to go into the aesthetic space, which we'll talk about sometime later. We think of like 5 or 6 companies that would potentially make a run at Endo, and the play would be that they couldn't acquire Endo outright because the opiate exposure is too uncertain. And that's one of the reasons why it's not trading at its intrinsic value. Nobody's going to acquire Endo and then turn around and try to negotiate with these states on an opiate settlement.
Right, right.
Especially due to deep pocket theory. The deeper your pocket, the more the state's going to ask for. But they could. I think the play would be to buy a sizable stake in Endo, something small enough that it wouldn't require the suitor to consolidate earnings, because nobody wants to see large opiate claims going through their P&L.
Right.
So maybe something like 39% or 40%. Can't quite remember what the cutoff is, but to buy 40% at a very low price. You're talking about to buy 40% of companies with a $600 million market cap. It's like $240 million,
Right.
which is a rounding error. Which is a rounding error for some of these bigger firms. And then once the opiate headwinds subside, then buy the other 60%. This way they could acquire Endo on the cheap, which is not what management wants. So I think the management team is currently vulnerable to someone acquiring Endo on the cheap. And the way to stop that is to buy back as many shares as possible and buy back stock hand over fist. And the more Endo buys back and makes restricted, that's less shares available for short sellers to borrow against. I think Moderna is a sort of an outside. I know we thought of Moderna, months ago, but it's sort of an outside, maybe a dark horse to make a run at Endo. It has about $8 billion in cash on its balance sheet. It generates about $7 billion in operating cash flow through the first 6 months of the year. So paying $240 million for Endo for a 40% stake would be a rounding error for Moderna. But Moderna needs to diversify its earnings and its revenue stream. At some point, the number of people getting vaccinated, the demand for vaccines will decline, and the supply will increase once Novavax comes on. Novavax is vaccine expected to come on to get FDA approval. Well, I wouldn't say FDA approval, but to get regulatory approval. Emergency use authorization in Q4 of this year or Q1 of 2022. Once Novavax comes online, the supply will increase, demand will fall, the number of people getting vaccinated will decline. So you have more vaccine makers, Pfizer, Moderna, Novavax, competing for fewer clients, fewer consumers. And I think that can drive the price down, could drive Moderna stock way down and hurt its business prospect. It's right now it's a one-trick pony. It's great that its stock is at $400 some a share, and it keeps putting out press releases once a week about booster shots and so on and so forth. The stock is woefully overvalued given that it's relying on one product at this point, whose shelf life is still uncertain. I think it would behoove them. I mean, again, they have so much capital, they don't know what to do with it, and they're talking about buying back their stock at inflated prices. A better use of their capital would be to, again, take a major stake in Endo, which would eventually diversify the revenue stream, which would make the stock more attractive, down the road when the pandemic subsides. So It's these companies' fiduciary responsibility to, in my opinion, to invest in Endo if they haven't already. And the play, I think, was probably warded a lot of people off with the open exposure, but the play could be take a sizable stake that wouldn't give them majority of control, then try to buy the rest sometime in the future when the opiate hit. What that means for short sellers is that you have even having buyers coming in and buying more shares that may not be available to be bought against. So that can also create a short squeeze and also reduce the ability to find new shares to short. And as Mr. Mitchell pointed out earlier, there are some things that individual investors can do. I'm not a stock advisor, so I can't tell somebody what to do. I can't give stock advice. But again, registering the shares directly with Endo could make those shares unavailable to be bought against. Also, putting a sell limit order at high prices of like $200, $300 a share can make it hard for those shares at prices that are almost criminal. So that excuse me, not end up, but to make it difficult for short sellers to buy back stock at prices that are criminal. So they can short them, but can they buy them back?
All right.
So I think there may be some of that supply could be coming from individuals who do not know their shares are being shorted. I know there are a lot of people putting limit orders on Endo at $2.80 stock. You put in a sell limit order, really? Either you like the company or you don't. But those are certain things that, again, individuals can do to make it difficult for shorts to borrow against their shares or to buy them back at prices that don't make a whole lot of financial sense. So I think these moves could limit the amount of shares that shorts can borrow against. And if they can't keep borrowing new shares, I think this trading scheme where they're trading shares back and forth begins to unravel, and you can see the stock spike, and you can see margin calls and capital calls for some of these short sellers. So I guess the last thing again would be the risk that someone with an activist investor is always a risk, but the risk that I think it's a big risk that an industry player could come in and start buying a sizable stake if they haven't done so already. I think that's a big risk.
Yeah.
I think it's a big risk for short sellers. It's a big risk for Endo's management team. It doesn't behoove anybody to let a strategic partner come in and buy this company on the cheap. So I think it behooves Endo to continue to buy back stock hand over fist. So, is there anything else from Mr. Mitchell that you'd like to add?
No, I mean, I think we've pretty much, summed it up. I think the only thing that I would add to that is, I think Endo outside of biopharma circles is gonna largely not a household name. They're not a Johnson and Johnson. They're not a Pfizer or Glasgow Smith Kline. Where it becomes synonymous throughout generations. But as a result of the visibility due to the opioid crisis and the cases that have been happening, it's certainly put Endo in a high visibility position. So even investors that may not have and on an institutional level, hedge fund level, high net worth level, chief investment officers, even maybe, family offices and the like. But in other words, even folks that have not necessarily paid attention to Endo has certainly put Endo in a spotlight in terms of awareness. And these are going to be folks that are going to be doing some number crunching and some math. And I think because of that visibility, I think one of the inadvertent consequences of being a part of the opioid crisis is that now more people do know, and people that are going to look at this as a potential opportunity to pounce on the company to either hostile takeover, potentially scoop up a competitor or potential competitor for pennies on the dollar. That's what this does. It becomes a billboard sign for Endo. So, it just becomes more imperative, in other words, for management, simply because they're not a braggadocious type by any stretch of the imagination. One can easily tell that this is a company that simply focuses on results. They kind of put their head down and they see the target that they have to hit, and they keep driving forward. So these aren't show ponies. In other words, they are a company that just simply rolls its sleeves up and gets the work done. So because of that, I think because of that approach, it's allowed them to not only survive but to thrive. In other words, and the last thing that you want to see is this, cacophony of different mixture of firms on an institutional level, competing biopharma companies, even activist investors that are now looking at Endo as a potential opportunity to eat pretty big. So, again, that's the one thing that I would just kind of add, that may not immediately come to mind, that as opposed to even a few years ago, where Endo was not much of a household name. They were an effective participant, but just kind of behind the scenes. But now you're front and center. So now the target not only grows bigger, but there are plenty more targets on your back. In other words, now that folks know who Endo is, and the effectiveness of the company, to be able to put out great product pipeline, to be able to service debt well, and to be able to do it in such a way that they've been able to build up a nice war chest of cash. So yeah, that would be my only kind of 2 cents
Okay.
to add.
Okay. So I think we've been pretty much flying blind. We've been guessing about how many shares Endo has repurchased, and I think on the Q3 earnings call when they released Q3 earnings in early November, we can look. You can see through the cash flow statement how many shares they've actually bought back. They may actually talk about it on the earnings call, how many shares they repurchased, but that could definitely be a catalyst when the market realizes that Endo's buying shares, repurchasing shares on the cheap, and just how aggressive they've been at repurchasing shares. That could be a catalyst. So in between now and then, we'll see what happens as far as the volatility in the stock, the actual share price, and if we see shorts beginning to cover. But we do this a lot for individual investors who may not be as savvy as some of the bigger investors. So if there's something happens, if there's a margin call or a short squeeze or what have you, or if the stock spikes, I doubt if it will be cinematic. So the opportunity to get in is now. Anyway, that's I'll take. So that's Trump and the G. Thank you for listening, and we'll be back in a couple of weeks.